All right, we are back. It is June 3rd, and this is the Trillion Dollar Show. I'm Neil, founder of Tax Sherpa. With me is Serena, our ops manager,
Hello.
Fatma, our admin extraordinaire. And this is the show where we aim to get people to pay $1 trillion less in taxes. And I actually just sent out an email today about Serena, you haven't even seen this yet. So Elon Musk is in the news today because he tweeted something, and basically he's coming out against the bill that's in Congress right now, the big beautiful bill as it's called, and he's saying it's simple math, and they're spending too much and blah blah blah. Here's the problem with that: is that I've been doing this a long time. I've been in the tax world since 2009. I've done over 50,000 tax returns. I've worked on billions of dollars worth of client earnings. And here's the reality is that seeing all those thousands of people's financial situations, it does not matter how much you make. There is no amount of money you cannot spend. And that's true for individuals, that's true for families, that's true for governments. And so, if you're concerned about the debt, you're never going to succeed when you're trying to cut off the spending part. What you have to cut off is the revenue part, which is, your tax money. So the the way to impact that and impact inflation and impact all those downstream effects is to pay less in taxes. If you give them less to spend, they can then spend less, and that's just it. That's just how the incentives of the system work. And what we saw during the last years with 2021, 2022, when there was high inflation, Americans will not tolerate 10% inflation. So that's like the limit of how much they can print over and above the amounts that they raise through tax revenue. So if we take them from 4.5 trillion of revenue down to 4 trillion of revenue, or down to 3.5 trillion of revenue, then they can spend less, and they can only print so much above that, and then that's how we reduce the debt. Um, well, it may not reduce in absolute terms, but it'll slow down. So, that's the debt versus deficit issue. So that's what we aim to do here. So, like I said, I'm Neil. I created Tax Sherpa to do that. And the way we do that is to bring tax saving strategies, technologies, and everything to the masses. And this show is one of the ways that we distribute that knowledge so that people can make their own decisions, improve their own situation, and pay less in taxes. So um, that's kind of the intro. um, you know, Generally we'll do this by example through Q&A. So, Serena and Fatma, they have questions. People have written in, we get, I don't know, 100 questions a week from clients and from, various people. And so, I have no idea what to do tomorrow, but we'll see what we find out. And the answer is always, Serena, what's the answer?
It depends.
It depends. And that's the answer you get from accountants and lawyers all the time. It depends. And because it's true, it does depend. So it depends on what we call facts and circumstances. So what's true for you may not be true for somebody else. It depends on the particular facts and circumstances. And sometimes it comes down to motivation, like your internal mental state. When you made a particular decision, does that make something deductible or not? Or does that make something income or not? It depends. So without any further ado, why don't we just jump in? And Serena, what's a question we have this week?
So someone wrote in and said, "What do you look at first when helping clients reduce W-2 taxes?"
That's a good question. So, what do you look at first? So W two, assuming you're working for somebody else, or it's not your company that you have a W two with. The first thing to look at is, well, it's kind of two things. So one is you know directly impacting the W two. The only real way to do that is to attack your retirement strategies. So if you have qualified 401ks or 403bs or 457s or whatever, then those are places to affect that W two number. Other than that, there's not many ways to directly affect the W two number. If you can convert to contractor, that's a whole other thing. That's something that's down the line. We talk about that later. But first, for some people, that's possible. For other people, it's not. Just kind of depends. The other thing is that we look at is what else is going on in your tax world. So, when I'm talking to a new client, my favorite question, is to ask them, well, what do you do when you're not at work? And I just let people talk and had all kinds of answers to that question. Very few people actually just go home, sit on the couch, and watch TV. It does happen, but it's rare. Most people are doing something outside of work. Just some answers that I've had. Raising snakes in a spare bedroom, raising and selling snakes. I've had people. I had one woman who was an attorney. She was a junior associate. She was a young attorney, and you would think, lawyer, that's kind of all you're doing, and you probably don't have time or energy or interest in other things. That's not true. So this particular attorney, she would go around the neighborhood and teach people how to cook in their own kitchens. And another person said, "Oh, I raise coral in my garage and sell it to saltwater aquarium people." I've had people just all kinds of random stuff. So a lot of agricultural type things like the snakes. I've had snakes, coral, invertebrates, lizards, fish. A lot of agricultural type thing. I actually think this is just an aside, but I actually think there is something about dealing with living things that people miss, in the kind of modern city life, so that they do these things involving agricultural type activities. But yeah, so a lot of those other things, whether it's, you know, some kind of side hustle that they're doing, whether it's, oh, I also have these 3 houses that I own, and rent out, or it's, my wife does this, or, you know, uh, my kid is streaming on YouTube and making 10 grand a month. That was one that actually happened. So, what we do is we try to shape those other things in order to be as tax advantaged as possible in order to potentially counteract that W-2 income. Because again, looking at the W-2 directly is, fairly limited. And so those are the first avenues of attack. And then from there, there's all the other stuff that we could go into. But those are kind of the number one and two that we look at.
Sounds good.
All right. All right, Russ. So we have a question from one of our clients. So he asked if what is the difference between a Form 8821 and 2848?
Oh, yeah, entirely different. So 8821 is an information authorization where it allows us to pull records from the IRS. So usually those could be transcripts. So there's a system in the IRS where you can upload these authorizations, and you have to spell out like what years and what forms is the tax professional authorized to look at. 2848 is a representation form. So that's the authorization for this tax professional to talk to the IRS on your behalf. So 8821 is read only, 2848 is talk to and receive. So that's the difference between the two forms. So that one it doesn't depend. That actually has an answer.
All righty. So we have another question that just came in. Which 3 strategies should I be focused on mastering right now if I decide to do my own planning?
Yeah. So it kind of goes in order. So the first thing you want to get your hands around is entity selection. So what are you doing? Why are you doing it? What's the right entity for that? So it could be, our usual approach is LLC. So LLC is a legal wrapper, but it's not a tax status. So LLCs can be taxed as a disregarded entity, in which case you just file a Schedule C. And that's saying you and the company are the same person when it comes to taxes. It could be a partnership. It could be a S corporation. It could be C corporation. So also, or do you need a corporation, or do you need a PA, or do you need a whatever, an LLP, for example. First that's your first decision is what entity is right for me and what I'm doing in my particular circumstance. From there, and when I say entity, I mean taxable entity, because again, the legal wrapper around it could be different depending on what you're doing. But those are the basics: disregarded entity, partnership, S corp, C corp. There are some other variations, but not applicable to 99% of people. So that's number one. And then from there, the next thing to do is to figure out, probably number two is going to be accountable reimbursements. So accountable reimbursements, an accountable plan. If you ever worked for a company and you went out and went on a business trip and you spent stuff and you had to hand in your receipts and the company reimbursed you, that's an accountable plan. So the accountable plan is, especially for small business, is built to reimburse you, the owner, or you, the employee, for business expenses that you have that you're already incurring personally. And so, there's a lot of work to be done there, but, it could be home office stuff, it could be car stuff, it could be travel, it just depends, right? So that'd be number two. And then number three, so number three, I would say would be compensation optimization. So that's usually what we do last, actually, but it is a big mover at that point because we were just on the call with a client. We're talking about QBI. So QBI is qualified business income. And the tax code currently, from the Tax Cut and Jobs Act, it has what's called the qualified business income deduction. And this is a break or a discount or a deduction on qualified business income that you receive from pass-through entities. Could be Schedule C, could be Schedule E, could be Schedule F, could be S Corp, could be a partnership. Any of those can create qualified business income. And then you could get up to 20% deduction on that income. So if you have $50,000 of profits from one of those, you might only be paying tax on 40 of it. And so it's a big deal, right? Getting 20% off of your income. And the bill that's in Congress right now is talking about raising that from 20% to 23%. So that's the whole thing. So number one, entity. Number two, accountable to reimburse yourself for money that you're already spending personally and lowering that taxable income. Number three, I would say compensation optimization to make sure that you're doing things in order to maximize things like the qualified business income deduction while maintaining compliance with other regulations depending on the entity type. And then once you have compensation, then that also brings into the picture any kind of retirement planning you want to do for solo 401ks or whatnot. Most of the time, solo 401k is going to be the most efficient retirement planning strategy. And so those would be the first three to look at.
Okay,
Right.
sounds good.
Yeah, so for my next question, boss, how can we structure foreign tax credits to avoid double taxation and dividends from a passive foreign investment company?
It can be tough. So there's the form 1116. This is your foreign tax credit form. The problem with the 1116 is that it depends on the character of the income and it depends on how much income you have. The more income you make here domestically, the less credit they give you for the taxes you paid over there. So if you're under a certain threshold, depending on filing status and all this kind of stuff, you'll get 100% credit. And most other places where you're paying tax, your taxes there are going to be higher than the taxes here. So the basic idea is that, okay, let's say I go to Germany and I work for a German company and I pay German taxes on that income. But I'm a US citizen. So US citizens have to report worldwide income regardless of source. And so I've got to report that income here in the US, but I'm on the 1116, I'm also reporting that I already paid tax on this money over in Germany. And if the amount I paid there is equal to or more than what I would have paid here, then the US government says, okay, you're covered, you don't have to pay extra. But that math starts to change as you make more. So I've had instances where professional athletes, they were this particular one that I'm thinking of worked in the UK in a soccer one of the soccer leagues, and he made a couple million pounds, right? And he paid a whole boatload of taxes over there, but he didn't get full credit here in the US. So even though he had already paid in the UK, he had to pay more here in the US, and there was double taxation on that. So it's tricky. And it depends on whether it's a job or whether it's dividends, so there's active versus passive, general category versus passive category. And then sometimes there's modifications depending on which particular country it is, because there's different relationships between the US and other countries. So it gets complicated. And that is very much an it depends answer. but that's the general way you do it.
Understood. So it looks like we have another question that just came in. Someone wants to know, can I write off my hair and nails because I'm on social media?
So it in very limited circumstances, yes. Most of the time, no.
Right.
So so here's the thing. There is a presumption of living cost that the IRS bakes into things. So this is why, for example, if you have a business meal, it's only 50% deductible in most cases at best because you got to eat. And the government
Mhm.
knows you got to eat, right? So they're not going to give you full deduction for something you had to do anyways, right? So similar thing with haircuts and nails and all that kind of stuff. Some people get a little bit overzealous when it comes to uniforms. They say, "Well, I gotta look nice to do the thing." It's like, well, if you look at the definition, it's got to be clothing that you cannot wear in social settings, right? So, like, if you're a mechanic and you have an overall and it's got your name on it, okay, that's a uniform. But if it's, I have to wear a nice suit, not a uniform, right? Because you can wear that out and just be fine. So similar kind of thing here. If you were doing something that showcased a specific product, then maybe. Like, let's say you were selling wigs and you bought the wigs and you wore the wigs in your social media, then okay, you have an argument there. But if it's just I got my nails done because I got to look good, then that doesn't cut
All righty. We get that question a
it.
lot, a
I know
whole
it's
lot.
not, that's not what you want to hear, but yeah, that's how the code is written. Because again, there's a presumption that there's basic stuff you got to do to live your life.
Right. So getting my hair done every 2 weeks and saying it's for social media, it's like bull crap.
It's not bullcrap, but it's just not really deductible.
Okay. Understood. Thank you, Neil.
Yeah, so we have a question, boss, from
Yep.
one of our client again. So what is the Augusta rule and how does it work?
The Augusta rule. So I'm in Atlanta, Georgia, and the Augusta rule comes from Augusta, Georgia, which is about 2 hours that way, actually. Um, so in Augusta, Georgia, there is the Masters Golf Tournament every year, and in the this is one of my favorite backstories. In the Revenue Act of 1976, there was a little provision that was slipped into the legislation that is still there today. It's 280 AG2, which is the Internal Revenue Code section. And what it says is that anybody can rent out their primary dwelling for up to 14 days, and whatever revenue you have from there is excludable from your taxable income. And similarly, 280 AG1 says that expenses from that are not deductible. So basically, if you have a primary dwelling and you rent it out for up to 14 times a year, if you go 15, you're breaking the rule. But 14 times or less, then that revenue that you get from that rental activity is not part of your taxable income. So it's just excluded. Okay, so what this originated from was there was a bunch of rich guys who live around this fancy golf course, and during the tournament, they wanted to rent out their properties and not pay taxes on it. So they lobbied Congress, and they got this code, put into the legislation. And I've actually looked up the legislative notes. So I was born in 1980, so I wasn't around for the Revenue Act of 76. But if you look at the legislative notes, it talks about the committee hearings that have, and how the bill has changed over the committee hearings and, same kind of stuff that goes on today. And if you look one day, it's not there, and the next day it's there, and there is no discussion about it. so, so this was just slipped in there and is still there 50 years later. So it ended up being called the Augusta Rule or the Masters Rule or whatever because of that connection. And every year, if you look at the Augusta newspaper, which is I think the Augusta Standard, I think it's what it is, they'll run an article every summer around the tournament. It says, so and so is saving, however many thousands of dollars in taxes by using the Augusta rule, which is kind of funny. So that's what it is. Now you can supercharge this if you have a taxable or if you have a company that's a distinct taxable entity. So this does not work for Schedule C companies, does work for other things, like S corps and partnerships and things. So the way to supercharge it is that you have your company rent your primary dwelling from you for up to 14 times a year. Now, here's where people screwed up. People screwed up because they picked the wrong number. They'll say, "Oh, it's rent is $10,000 a day." It's like, well, okay, based on what, right? And there have been court cases where numbers have gotten thrown out because they just didn't have any documentation or didn't have any reason for the rent they were charging. And the other thing is that, for any business deduction, there has to be a purpose behind it. So what is the business purpose for this rental, right? And so the way we help with that is that, well, one, we do market research and we figure out what's an actual number based on actual listings in your actual place, so that we can get an actual justifiable amount to deduct. And the numbers can be decently significant depending on where you live. I remember, I think it was 2 years ago, we actually saw rental numbers go down, and we had clients emailing us to say, "Hey, this is less than last year." I was like, "Yeah, just because that's the market." Rentals had gone down that year. So anyway, that's number one, and then number two is for the business purpose, for why does the business need to rent this place from you, and the answer is to the answer is generally going to be to have a management meeting. So, we have templates and things to guide you through how to have a management meeting, because one, this is something that business owners should be doing anyways, and two, most small business owners don't know how to do it. So I've got a process of looking at your books. Got a process of looking at your books, reviewing the past month, the past quarter, and the past year to date, and then comparing that time over time to the previous, and then looking at trends in those numbers and what to do going forward, and how did your plans from last time work out. So it's a real management meeting of your business, which you need to be doing. There are other ways to approach the Augusta rule. So some people will have like holiday parties, which is gets kind of iffy sometimes. But it's a valid strategy as long as you follow the rules. That's really what it comes down to. So then you got to make sure that you do that.
So you got to make sure you're following the rules, or it's not valid. So it looks like we have another question that came in that says, "Why does the IRS say I owe money when I've already paid?"
So we
get that a lot.
We've gotten this a lot this year.
Yeah.
It's not usually such a problem. So what happens is, throughout the year, you make payments, whether you made the payments through estimated payments or whether somebody else made the payments, like through withholding and things. Then that goes into an account. That account has your Social Security number tied to it. And then you file a tax return. And the tax return has this, that, and the other listed on it. And what the IRS or the state agency, for state departments of revenue, they will match up what's on the tax return against what's in their account. And so, like here in Georgia, we've got a bunch of Georgia clients. We've had, I think, 3 in the last couple of weeks where we submitted a return, like 2 months ago, and somebody gets a letter saying, "Hey, you on your return you listed this, but we only have this in your account." And then we've got to go do the whole thing where it's like, "Well, here's the checks, you cashed them, give us credit," and it's a hassle for sure. That's why it's important to keep records of all your payments. Now, interestingly, that ties into the executive order that Trump signed at the end of March. I can't remember the number of the executive order off the top of my head, but what it said was that they are modernizing all payments to and from America's bank account, by which they mean all executive agencies, but also includes the IRS. So as of September 30th of this year, the IRS is not going to accept checks, and they're not going to pay checks either. They're going to only do electronic funds of some sort. So on paying to the IRS, you got to do EFTPS, or you can go on your personal account at irs.gov. If you have one, you should sign up for one if you don't have one. Or you can do ACH. And I think that's it going forward. And then on the refund side, they'll do direct deposit like they have been, or they'll send you a prepaid debit card, which is going to open up a huge avenue of fraud. But I won't get into that right now because it just makes me angry. So, so all that is to say, the upshot of doing that is that, there will be better recognition of payments against claims with digital transfers, because we'll have, bank account transfer, whatever that we can point to and very easily prove that something was paid, rather than going to a check, getting the image of the check and sending that in. It'll just be better overall because tracking will be better. But that doesn't apply to the states. So we'll see what each state does in response. But yeah, I mean, that's what happens, is that there's some kind of mismatch between what's in their record and what's in your record. And if there's a mismatch, then you'll get a letter saying, hey, you said this, we see that, pay us the difference. And the funny thing is that when you get those letters, it's always just pay us the difference. It's never explain the difference. It's never let's look into what happened. The way the letter reads is just pay us. So you have to have the wherewithal to know that, hey, I don't owe that, and let's look into what happened and respond if needed. So most, I think it's like 70% of IRS notices never get any response whatsoever, and people just take whatever it is. So you gotta fight for your rights, like the Beastie Boys said.
Yeah. So for my next question, boss, is there a way to use my IRA or Roth to invest in real estate tax-free?
Yes, there is. So in IRAs, whether it's Roth or traditional, doesn't matter. There's a list of things you cannot own. And most of that is collectibles, like collectible art and stamps and stuff like that. But pretty much, if it's not on that list of 8 or 10 things, then everything else is fair game. So you can invest in real estate because real estate's not on that list. The caveat you have to watch out for is that you cannot personally benefit from that real estate. So you can't buy a house through your IRA and then move into it. And your family can't move into it. It's got to be third party, right? Arm's length transactions. So as long as you do that, then yeah, it's fine. What people will usually do, because title agents really aren't comfortable with having the owner of a thing being an IRA, what they'll usually do is the IRA will open an LLC, which will be Smith Investment LLC, whatever, and it'll be a regular LLC. It just happens to be that the shareholder of that or the member of that LLC is an IRA. And then, title companies and closing attorneys are very, very accustomed to dealing with LLCs as investors in real estate. And so the transaction goes through no problem. In order to do that, though, you have to have your IRA at a self-directed custodian. So there's a bunch of them. I think Trust ETC is probably the biggest in the country. And, they allow you to control and sign for things without getting the intermediary having to sign off on stuff, which can be a giant pain in the ass. So you park your IRA, or at least a portion of it, at the self-directed IRA place, and then open the LLC, and then the LLC performs the transaction of buying the real estate and then selling the real estate. And because when you sell, because it's inside of an IRA, it is either tax-free in the case for Roth or tax-deferred in the case of a traditional. And it's only when you take the money out of the IRA that a taxable event occurs. So if you have the funds in the IRA to do it, it's a great way to accelerate your retirement, and either provide income or provide capital gains over time. So definitely works.
Alrighty. Looks like we have another question that came in. It says, the client wants to know, I have rental properties. Does my accountant use Schedule C method or Schedule E method, or what is your take on this?
Yeah, so schedules. So there is a debate amongst accountants for short-term rentals only. If it's a short-term rental, maybe you're in a Schedule C activity where you're performing services, or maybe it's a Schedule E where it's what do you call it? The asset is performing the function. So Schedule E is your normal rental schedule. So if you have a long-term rental that you own and potentially manage, maybe not, that's going to go on your Schedule E just normally. So in the short term, it's like, how much work are you really doing? Are you performing a service, or are you providing an asset that is then used by the renter? So there's a little bit of nuance there. It's very rare that a Schedule C would actually be appropriate in that situation, because we do actually have one client that it is appropriate, but we've restructured that whole thing, it would have been appropriate. So in the case where the rental is incidental to the services being offered, that's how it's described in the IRS language. So in this case, like if you have a retreat at your property and you are the host, and you're doing like a mastermind or like a meditation retreat or something like that, then you are doing work, and that's what you're offering is that service, and the rental part just happens to be there as incidental to fulfilling the service that you're offering. So in that case, it would be a Schedule C, but that's pretty rare that would be appropriate. So most of the time, going to be Schedule E, but again, it depends.
Understood.
Yeah, so I do have a question, boss. How much should I be paying myself from my S corp?
There is no answer. So, the reasonable comp is the question. So in the structure of an S corp, profits from an S corporation do not carry self-employment consequences. Profits from a partnership usually do, and that's a huge difference. So what that means is, if you're working for yourself and you're filing a Schedule C, or you're working for a partnership and you have a K-1 come in from partnership, excuse me, then you're going to pay income tax on whatever the income tax implication is, but then you're also going to pay self-employment tax of 15.3%. And that's the self-employment version of Social Security and Medicare. It goes to the same places. So with an S corp, you don't. And that's a 15.3% difference, which is why in a lot of cases, S corps are more advantageous than those other arrangements. Now, obviously, the government is aware of this advantage because they created it. And so there's this countervailing instruction that you're supposed to pay yourself a reasonable wage or reasonable compensation on first money out of an S corp. So the next question becomes, okay, what's reasonable? And there is no answer. So, there are different approaches. The best approach is actually to document your time over a couple of weeks and figure out what it is that you're actually doing. And because let's say you are, I don't know, let's say you sell tea. We have a client that we brought on recently that sells tea. So, and I have a tea decanter right here. So if you're selling tea, what are you actually doing? Well, you're going to be doing all kinds of stuff, right? You're going to be farming, you're going to be planning, you're going to be doing admin work, you're going to be doing collections, you're going to be doing billing, you're going to be doing sales, all these different things, because all small business people wear multiple hats. That's just how it is, right? The small business. And so if you want to be really thorough, what you would do is you would research in your market what each one of those things pays, and figure out how much time you're spending in each of those roles, which might be surprising, when you actually write it all down, and then come up with a weighted average of what your hourly rate would be, and then pay yourself based on that. So that's a way that has been defended in court and has won. So that's something to keep in mind. Reasonable compensation audits are relatively rare, compared to the number of S corps that are out there. The last number that I saw, which was a couple of years ago now, there was about 15 or 16,000 reasonable compensation audits, and that's against 4 million S corps that are out there. So it's a small concern, but it is a concern, right? And you want to follow the rules, accurately. But what happens is that it really comes down to Social Security tax. That's the main concern. The government wants to make sure you're paying your fair share of Social Security tax, because Social Security is broke. So, that's the big concern. So when these things have gone to court, and you read the court opinions, whenever the court asks, well, Mr. So and so from the IRS, what should Mr. Johnson have paid himself for his compensation from his S corporation? And the answer is always magically whatever the max was for Social Security that year, and it changes over every year. And so that's how we know that that's what it's actually about. Um, so you know, so you have to keep things in mind, as far as what is reasonable based on the work that you're doing and the actual size of the company, because it's also against guidance to create net losses by paying yourself a compensation. And this is getting more technical than you probably need, but I have seen cases where people drive themselves upside down because they think they're supposed to pay themselves and create a loss, which is not correct. You're supposed to actually defer and then accumulate over time. But again, I don't want to get lost in the weeds there. So, so the answer is there is no answer.
That's
You
the
got to
first,
figure,
right?
yeah, you got to figure out what reasonable is for your business. And I will tell you, there are a couple red flags. So, red flag number one is if you have a lot of profit and a very low round number of compensation. So, if the company makes 150 grand and you pay yourself 24,000, 2,000 a month, that's probably not right. So like the most commonly audited reasonable compensations are 2,000 a month or 24 for the year, or 3,000 a month, 36,000 for a year, because there's almost no job will you actually get an exact dollar amount, in terms of your W-2. Even if you're on salary, there's adjustments for health insurance. Well, health insurance is another thing with S corps, but again, don't want to get lost in the weeds. Um, and you contribute to your 401k, or there's all these different adjustments so that on your W-2 the number that you actually get is different than whatever your salary is. And so you want to think about that. It's like you want to be paying yourself for the work that you do, just like you'd be paying anybody else. Now, granted, nobody else would work for you, because that's why you're that's why you're in business for yourself, because nobody would work for you and you wouldn't work for anybody. So, but if we play pretend and we say, okay, look, we hired out so and so for 30 minutes a week and this person for 2 hours a week, or what would all those things really cost? And that's how you can determine what your reasonable compensation is. And I have heard speakers at IRS events say that in this case or that case, the reasonable compensation should be the full thing. My position is that that is never the case, because if that is true, then the business doesn't exist, and the business should have structures, procedures, and things in place that generate a return on capital over and above the personnel cost, whether that's you as the owner also being the service provider, or you were to hire that out. So if your business, let's just say you bought a stock in, I don't know, XYZ company, and XYZ company provided or generated no profit over and above its expenses, well, you wouldn't buy that company in most cases. If there's a plan to turn it around, then maybe it's all this subjective stuff. But by and large, a company's share value is generated through its net earnings or net profits over time. And there's different models, and you can discount that into the future and whatever. So every business, regardless of size, should be generating profit on the capital allocation of that business. And that applies to you, that applies to me, that applies to every business. And so it should never be the case that the owner's compensation consumes the entirety. So I know that's a little bit technical. There's a lot of technical stuff today, but that's just my opinion on business financing, basically. Okay, I know we got to cut it short today because you guys have to run, but I did want to show people a new thing I created. Let's see here. I'm calling it the Tax Strategy Self-Check. So it's a quick checklist that helps you figure out, in your relationship with your tax professional, are you getting compliance work or are you getting planning? Compliance work is filling out the forms. It needs to be done. It needs to be done accurately, but that's not generating any dollars in your pocket. Planning is where we look ahead and we say, okay, based on this year, numbers year to date, we're projecting this. We can make these different moves based on your situation and save you X number of dollars, right? So a lot of people think they're getting planning when really they're getting compliance. And so this checklist is very simple. It's just, what is it, four? I should have counted this before. So that's 10, and then so it's 15 questions, 15 check boxes, and you score yourself, and then it'll kind of tell you kind of where you're at. So I haven't made a little sign up thing for it yet. So if you want to get it, just email us, office@taxsherpa.com. Put checklist in the subject line, and we'll send you a copy. And you can figure out if you are actually getting what you think you're getting, or whether you need to get more advanced sort of advice. So check it out, and we'll see you next week.
Alrighty. Have a good day.
See you later, guys.